and gentlemen. It's Modern Investing with Sasha. It's Wednesday, 1 o'clock as usual. And I would like to introduce my esteemed guest, Nick Paliveda, is founder of IBM TV, the Tech TV Network.
Thank you, Mr. Sasha.
Hello, Nick. How are you doing today?
I'm doing great as long as the market doesn't plunge into oblivion. I am happy.
Mhm.
Okay.
Okay, very good. The last, actually more than a week, probably close to 2 weeks or so, market was quite challenging. It went down big time, especially Nasdaq. So
hmm
the high yield dividend stocks, which is core of our portfolio, did quite well. Some stocks went even higher. Some stocks held their own pretty well. And also, I would like to introduce Peter Bennett, our regular contributor.
Hey,
Hello, Peter. How are
Hi.
you doing? Graduate of New York University and former Wall Street professional. How are you doing, Peter, today?
oh, good. Everything's good.
Yeah, good. As I said, last 2 weeks were quite challenging,
Yeah.
especially Nasdaq, and high yield dividend stocks held their own. Actually, some of them, at least in my portfolio, moved higher. There is a great temptation to sell those stocks, but I did investigation on one of my stocks, is British American Tobacco Company, and there is a continuous inflow of capital into that stock, although it moved higher quite substantially lately. So I'm thinking about okay, so who are the people who own shares in British American Tobacco, and what would make them to sell? Because if stock to move lower, there must be imbalance of sellers and buyers, so there should be more sellers. But you see, the most of the holders are institutional investors, high net worth individuals, and it seems to me there is no reason for them to sell it because it still pays not as high as before. It used to be 8.5% dividends. Now it's probably 7.5 because it moved higher, and there is no inclination for them to sell it because if they sell, they have to move somewhere else, and where would they move the capital? They have to find equivalent of high yield dividend stocks to move there, and it's more and more difficult to find alternatives. What do you think, Peter?
Well, it's consumer staples, and I never bought the cigarette stocks just because it's cigarette stocks, and
Yes,
but
yes.
so and some people feel that way, and I feel mixed about it for sure, and
Hmm.
to negative. But I own RHS, and they own one or two of them, and I'm okay with that because con- consumer staples is a place to be. And the only argument against cigarette stocks too is obviously,
Yes.
where will it go in the future? But I've heard now with COVID, a lot of people, and also some rules against vaping, that kids, unfortunately, are returning to cigarette smoking. People are. I guess they're nervous about COVID, and whatever reason, cigarette smoking has been up lately. I heard that this week or so. But more importantly, I mean, any consumer staple I like to a good point, because this was going to be my first point of the show. Is there's four words I was going to say that define where the markets are going. It's inflation, energy, and inflation. Oh wait, that's two words: energy and inflation. I've never, and there's never a guarantee, but I've never felt like I had a handle on where things are going to go in the future as well as I do now. In other words, I'm not positive because you can never be positive in the market, so that you have to stay diversified. I'm 45% fixed, whatever it is, and then and even then I have diversification. But I am operating as if we are heading towards a very long, hard inflation. One, and also a very long, hard energy rise. And every single week, I've been saying this especially about energy, for maybe almost a year now, but every week I see more and more and more and more. It's just articles and different points and everything that points to the fact that this is the macro view you should have. And that means, one, you need to be very defensive and dig in and make sure your stocks can survive this, because um, given a history back from 1965 to 1982, there was, or roughly, depends on how you define it, it was called the Great Inflation. And inflation was huge during this period. A lot of older baby boomers remember it. But I believe the average was 7% a year, which not maybe coincidentally is where we are now. Inflation 7%. But I think it's going to continue for so many reasons. One, rents lag housing prices. So this year is already, the rents are going to go through the roof because housing prices went up maybe 20% nationally. Two, labor. What happens is once you get inflation, it creates a psychology. And now the psychology is, well, the labor markets are short and the Biden stimuluses and infrastructure made it worse. But and now there's a big, like I can quit my job because I'll get a better job, and employers for the first time are begging, unlike in the past, they need employees. So it's a whole new psychology. And three, energy, which is the worst kind of inflation. It's the worst kind of inflation because it's a tax ultimately on everybody. It's a tax on the companies because they pay more and they can pass the prices sometimes to the consumer. And it's a tax on the consumer. And the evidence for that, I had two that I was talking about last week, which the main points is one, energy companies are underinvesting in exploration production dramatically. This is established. In the USAC call, one of my holdings, they talked about they believe that the energy companies are putting in 40% too little capex just to maintain the levels now. Now, additionally, and what they're doing with the money, by the way, is they're returning it to shareholders in the forms of dividends and also buybacks. But this makes perfect sense because they might be thinking, look, if in 20 years we're not going to exist anymore, or we're going to have to transform ourselves, then, and also, by the way, a footnote too is they're also investing in new technologies. So, like, I think it's 10% of a major oil company, I think it was Exxon, is going towards just carbon sequestration or, other types of energy. So, because they're trying to change, they're trying to get ready for a future where they may not thrive. So they're not going to keep investing and over-investing in oil. But here's the third point now. This came up this week. I could not believe seeing this. But I've seen in a couple of different articles that OPEC is actually has very little spare capacity. And as a matter of fact, they are not meeting their quotas, which is a revolution. So they have set certain quotas for each country, and they're not even getting up to the quota levels. Now, the reasons for that could be several. One, maybe they just saying, okay, we'll just let prices rise. But two, this comes back to a long time ago. There was a concept called peak oil. And maybe, nobody really knows how much they have. There's questions about how they report their reserves, but it could be that they're either facing peak oil now, where they won't be able to produce as much because they can't seem to have, they have no more spare capacity, or they may be looking down the road and saying, you know what, in 10 or 20 years, we're not going to be able to produce that much. So we better, not push our production. So when you add all this up, JP Morgan said 125 to 150. Now the Fed, by the way, going back to them, how are they going to control this? A few weeks ago, they were saying 3 rate increases. Now I'm hearing 4 or 5. Some people are saying 7 rate increases. But as they raise rates, they're between a rock and a hard place because one, in 2018, when they raised rates just to 2.5%, it did slow the economy, but it dropped the market 20% just from that alone. And they may need to do a lot more than that to control the coming inflation. And two, Medicare goes into deficit in 2026, and it's going to be an unbelievable change because instead of taking money out of the Medicare pool, the government's going to have to pay for Medicare and print even more money. And that's what caused a lot of people, including the San Francisco Federal Reserve, by the way, said the great inflation for that 20 years or so was caused by overprinting of money. That's what the San Francisco Federal Reserve says. So it's a tough situation. And I'll conclude this part with, you better be very defensive. I'm like over 25% energy now. Equity REITs are supposed to do well. Last week we talked about, the chart where it showed what does well in high inflation environments. I thought it was the best chart I ever saw. Consumer staples does well. Tech is the mystery, getting back to this now. And I'll hand it over to you on this because I can't figure it out because I love the tech companies. I like Google, although I'm mad of it right now. Amazon, Microsoft. I think they can grow even in an energy environment because they're so successful and they're so big. and the revenues have been growing. And if there's inflation, I think they can pass some of it on to the consumer. But the tech has not been happy about the inflation that's been going on and the fear of inflation.
Peter, do you think that it's possible because of this acquisition announced by Microsoft of Activision Blizzard, there could be further M&A activity in tech sector, which could actually, some companies maybe like Activision Blizzard was a big winner out of this announcement, going higher than 26% or so in a matter of a day.
Sasha, I saw that. Could you tell the audience and me too, because I don't have all the details, what happened with Activision and Microsoft? Because I didn't
Well,
see.
basically, Microsoft
Big cash deal.
making all cash offer of around
Okay.
$70 billion. It's quite impressive. Who would think that Microsoft can just write a check for $70 billion, and
Yeah,
it's not that they're investing their last cash available.
well, they have a lot of cash on
They
all
have.
those companies have so much cash on the books. A lot of them.
So if that's the case,
Big debt.
basically they explain that they are attracted to a high level of expertise and individuals who are working for Activision Blizzard, and combined with their already sizable holdings in video games, that would create a giant. There are only two companies who would be comparable to Microsoft in video game industry: is Tencent, a Chinese company, and I believe Sony.
Right.
So
It
that's
makes sense, if you look at the metaverse that's coming too. By the way, I don't really know if the metaverse is going to be quite as successful, but I saw Walmart had a presentation this week of the metaverse, and they had you'd go in and this virtual thing would grab, in a supermarket, you'd grab the milk, you'd grab the groceries, and you'd be that person. I think people would rather go to a grocery store, but what about antitrust, Sasha? That must be a concern.
yes, it will be viewed. Yeah, there will be.
I think the acquisition is contingent upon there's contingencies.
Yes.
Like upon it passing.
I think the government is.
And not only in the US, but also Europe.
And overseas. So they have those hurdles to match. I agree with how the stock Activision went up. I thought it was pretty interesting. They went up about 26% in one day. Microsoft fell 2.5% in the same by the acquisition.
It's the usual scenario.
It's the usual scenario.
Right.
But if you think about it, from Microsoft's standpoint, they're still in the same industry. It's kind of a tech industry. They did not diversify. They put a lot of cash out on their balance sheet is going to be gone. But at the same time, they get to integrate a system they're familiar with into their system, which is all these video games that have been very successful, like Minecraft and Candy Crush.
Yeah.
Other things that, frankly,
Minecraft, all of them, they love Minecraft.
I know they do. But see, our generation, we don't play those games. Okay.
No, unless I'm forced to.
Unless we're forced to, right?
Grandkids made me play.
This is a generational difference, because when we're looking at these video games, I've seen my grandkids play Minecraft. Oh, you got to play this, Candy Crush. All these crazy games, World of Warcraft. I don't even touch it. I've never played them. I mean, there's definitely a big generation gap here when it comes to this particular acquisition. But if you look at it from their standpoint, obviously they must have done some of their homework to make that acquisition.
I still prefer chess to all the video games.
Yeah, well, chess has moved up because of the Queen's Gambit. Moved up a lot. Absolutely. But there's no way to monetize it, Sasha. It's real challenging. And what they do in a lot of these video games is they sell kids, and there's a lot of dispute about that. To make your person stronger, buy this special lightning gun.
Right.
And, Daddy, I need to buy this special lightning gun so I can kill the monster. How much is it? What's $10? What? For a lightning gun?
Yeah, you can send a fortune. Exactly.
Exactly. Here's the credit card. They buy the lightning gun. Then they go killing more monsters than they ever have. And that's kind of like how it works. So some of them are free, and then they have all these tack-ons. Some of them have base fees. It's reoccurring revenue. It's frankly, it's a pretty big industry.
Oh, if they could take it, I could see why they would want it. There's no question. Again, you look at the metaverse. Look, someday it may take 20 years, but we'll be able to go into a room, and there will be video all around the walls. It'll be like the holodeck on Star Trek.
Yeah.
And so you'll be in the situation,
AR, VR.
you know. Yeah, exactly. It'll be more like being there almost, closer to
Right.
reality. And that's really where the metaverse will hit. And that, by the way, will require
Yeah.
a huge amount of chips.
Yeah. Well, it was
Without a doubt.
certainly was big on the Wall Street Journal today, Microsoft's potential acquisition. But here's I'm also want to bring up from the panel: 600% Motley Fool, 600% return. Okay, I don't know if you guys see the commercials. Have you
Wow.
seen this? Subscribe to the Motley Fool. We made 600% last year. Okay, let me tell you just from a securities.
600%.
That's what they say. Okay,
That's good.
but here that's good. Yeah, you think so?
It's
But
unbelievable.
see, here's the problem, just for the
Yeah.
people that know. Okay, my securities registered brokers can't even come on the show because they have to have stuff approved by the SEC, FINRA, the Form ADV, the broker dealer compliance. They could never make a statement like what you're seeing below there if they're engaged as a professional securities industry.
I like
Why?
the question mark on that statement.
Well, I
by
had
the
to put a
way.
question mark it because the
I
thing is,
don't think so.
okay, but the thing is,
I don't
okay,
know, but
I am
that sounds
telling you,
impossible.
okay, I am telling you, they're
Yeah.
running commercials right now. If you subscribe to the Motley Fool, 600% we made last year.
Well,
Now,
they say 600% better than
return.
I mean, it
Okay,
seems
okay. I mean, I look at all the professional money
I'd have
managers
to look at the
in the
wording of that
country.
commercial, but it doesn't sound right.
You
I mean, I've
think?
read their
Okay,
articles. They're good
you
articles,
think?
but they're not that
Well,
great.
they're both professors at a university
Yeah.
that decided that working at a university doesn't pay as much as if I can go out to the marketplace and promote my stuff. So they started promoting their stuff and they sold a lot and their investment ideas and advice. Then what happens, and this typical happens in some industry, the sales start slowing down, so you need something to jazz it up.
Oh, 600% will do it. Yeah.
And 600% will do it. And I also saw it with Shriners. We see ads on Shriners. Oh, I'm a crippled person if you give money to Shriners. Okay, so I had to do some research on Shriners. By the way, they're headquartered in Tampa, Florida. I was by their world headquarters, a beautiful place on Rocky Point. I mean, a multi $1,000,000 office building. Okay, so what's with Shriners? Well, they only have 9 billion in the bank. Okay, no, that's not enough for them. They have 22 hospitals to run, so 9
Wow.
billion is nothing. So what
Right.
happens? The CEO wants to raise more assets to make sure all their jobs are taken care of. So to me, it's kind of disgusting. Then they parade these people around how, oh, donate to Shriners, donate to
Sure.
Shriners.
Yeah.
And PBS does the same bloody thing. Donate to PBS, and it all goes to $1 million salaries by the top executives.
Oh,
Not
yeah.
all,
It's a big business.
but it's a big business.
Yeah.
They make close to, if not seven figures. You can go look at their 990s, which is the
Oh, yeah.
form the IRS publishes on nonprofits. And let me tell you, some of these people that are working for not profits, they're
Yeah.
pulling in a cool $500,000 a year plus. Oh, it's
Yeah,
enough.
there's no question about it. Yeah, I mean, and you could argue whether they're
Gosh,
worth it or not, but that's another thing. But
that's
you
a
know what?
whole
I
different.
just back to
Yeah.
what you're saying about the 600%. The only way I could have seen it that could be true is maybe they did a lot of options. I
All
mean, look,
right, sure.
if you bought the right options on just some Apple or Google or
Yeah.
Microsoft,
Yeah, last year, right.
um,
Sure.
yeah. I mean, those
Yeah.
things went up
Yeah.
50%, but your options could have
But
gone up. So
Peter,
they could have said, well, we recommended options on, Microsoft or Amazon. And well, Amazon
well,
did well, but I'm just saying if they picked some big tech and
yeah,
so that
exactly.
was, and they could have even said it,
Right.
you know what, let's plan this out. Let's buy a lot of Microsoft options and
Or Tesla.
Apple options this year, because if they go up 600% next year, we can advertise, and if they don't, we won't mention it. So
Exactly. By the way, the mutual fund industry, because
oh
we
yeah,
work with it, is horrible for this. Here's
oh
what
yeah,
they do. They'll always show the fund that earned
right,
40%. Okay.
right.
But they
120
have
funds, and
they
here's
have
our three
120
best.
funds. They have hundreds, and some of them have
Yeah,
thousands of funds.
yeah, that's been
Okay.
going on
And
forever.
then they'll show the one that earned, 40% or some the outlier that year. And then next year they
Yeah,
go to the other fund, and
I
they've been
know.
playing that game for decades. And the public goes, oh, I got to put my money with Fidelity because Fidelity last year earned 40%. Yeah,
You know,
on that.
that's funny. That's funny. Back in high school, even somebody told me about the Fidelity funds, and Fidelity's a great company.
It's a yeah,
But
good
they
job.
had so many funds, and he was selling Fidelity funds, and I said the SEC should outlaw this. They should say you need to disclose all the funds'
All the funds,
performances.
right? And
But
the
instead,
average of
yeah,
all the
they can
funds.
pick and choose. So, oh, look at
They
our
can pick and
three
choose.
funds, how well they did. They don't tell you about the funds that bombed, and there's always
Right.
some good fun.
Yeah. Because what I'll do is I'll pick out the stock that I made 21% last
Right,
year. Okay, but what I didn't show is all the stocks that didn't make 21%.
right.
Follow me. I make 20% in the market.
Don't
Well, just
forget
in
also,
so that I mean, I'm sure there's some truth to the 600%, but the question is how they did it. But they couldn't have just been picking stocks
It
or
it
either they had penny stocks or they had options, is my best
it,
guesses.
it doesn't matter. Remember, it's a
Yeah,
commercial. The whole
right,
idea is
exactly. The main point is I wouldn't count on them for 600% this year.
yeah. By the way, don't bother watching our show. Go to the Motley Fool,
Right,
subscribe, and make 600%.
right. Yeah,
Okay.
600% on.
but
I
don't
have to get
forget
off the
one
show.
thing.
I have to get Motley Fool right away.
Yeah, right away. Right.
But
Yeah.
don't forget that the 600% is in the big letters, and this is all what people are focused on. They
Right.
don't read the small print that the past performance doesn't guarantee the future
Oh
performance.
yeah, yeah.
All those disclaimers.
They don't have
Most
to.
of the people do. Most of the people don't even read that stuff.
Yep, it
Right.
is a good website. I mean, look,
Another trick
they
is
do have good articles. I read their articles sometimes. It's not my
don't
first
forget that
day. Oh,
the way they operate is this: the subscription is relatively cheap, let's say $35 a year or
Oh,
something.
that is
it's
pretty
So
nothing.
cheap.
people, what is $35 for 600%? I'll pay you 55. So people write a check or
Right.
send their payments in a matter of a moment. A lot of these people also guarantee if you're not happy, we will return your money back in 30 days or so on. So there's an influx of people who will
Oh,
definitely
sure.
subscribe to that.
Of
Now,
course.
whether they will make 600% or even 500% or even 150% remains to be seen.
Yeah, of course, of
I'm
course.
quite
And you know what?
skeptical.
Some people will make money and they'll stay, and other people will go, but they'll, it's good for subscribers.
I
Again,
just
not to knock Motley Fool, because look,
no.
I mean, if I read an article
Yeah,
in
they're
Motley
good
Fool,
articles.
I pay attention to it. I don't look to them for my number one resource for
Mhm.
reading or research, but I come across their articles all the time, and they're well written, and
Yeah,
I
very
think they're
professional.
intelligent.
I agree.
But 600%, I'm not going to count on that.
Yeah, everything was good except that 600%. I agree. They have some really good articles
Right?
about stocks. They do as much
Yeah.
homework as they can.
I would like
But
to ask them one question.
But
They saying they're talking about 600%. Could they guarantee 60%?
hey,
no.
listen, in my industry, if they guaranteed 6%,
Right.
I
Of
can
course.
I can get them $600 million
Right.
very quickly. I mean, within like less than 30 days. Here's the problem. There's no insurance company in America that guarantees
No.
6% over the rest of
No, on a
your life.
guaranteed rate, what do you get now? 2% or something?
Yeah, basically we can get like two. You're right.
Right.
It's
Yeah. Yeah.
2%.
Yeah.
They want,
Sometimes I look for
and you
brokered
struggle for that.
CDs. That's
Yeah.
how I get the highest rate. I get like 10 years to almost 2%. I got to
Yeah.
lock some money out of at 1.9% on a CD,
Yeah.
just the fixed money for only 10 years. So if you
Right.
look for brokered CDs, that's a little tip to get a
Well,
little
see, the problem with all that, as you know, Peter, is that if the Fed starts increasing the
Oh,
interest
I know.
rates, you've locked into some pretty bad
Yeah, but it's
environment.
all, you know what? We're doing like almost a ladder where you can,
Oh,
let a
you're
lot.
laddering it? Yeah, they
Yeah,
probably
exactly. So,
should
we'll
get
have
that.
expirations. You know what? It's only again, it's probably not the time to buy the CD, but
Yeah,
just I was increasing my wife's proportion of fixed because
right.
she was too low. So it's like, okay, you know what? Maybe we can get 3% next year, but if it probably will be a bad short term move because next year rates will pay up. The other side is here's the problem: the Fed is going to raise short term rates and they're going to stop buying securities, but they can't. The long term, you have to fool the market, and the market is not really responding, I think, as much. So it might be that the Fed raises, the rates on a year, rates, 2 year rates, but this is the rock and the hard place I've been saying because the market may think, look, in 5 years we're going to have so many problems. that I don't want to lock in any money, so it's but well, let me rephrase that. Everybody needs safety with some of their money, and the insurance companies, everything. So it's just a very tough situation. That's the bottom line, to predict the future. But that's the hardest thing to predict. Somebody said that.
I'm subscribing to several investment newsletters, and one of them, written by a person that he was more often right than wrong, he was analyzing bank stocks, and he came to the conclusion that Goldman Sachs, J.P. Morgan, and Citi, and just many banks are grossly undervalued compared
they are.
to what they're going to earn, and especially in the higher
interest rate environment. I would agree.
So
yeah, you know what? But then if you looked at that chart I had, finance companies do okay in an inflationary environment. You'd expect them to do great. But the other side is, see, there's a few crises. I still think the office market is going to collapse, and
It could be a problem.
I think it's in the process of it. And so, then I get nervous. It's like, okay, it's J.P. Morgan has. I looked at their balance sheet and Citibank's, and they have enough other stuff, other investments, so that even if the office market collapses, they won't be destroyed. But it's going to hurt their performance a lot if the office market crashes.
well,
and I think the office market is
look at
poised.
J.P. Morgan latest quarterly report. They
didn't do well either. The market
didn't
didn't
do
like it.
and their
Yeah.
stock went down quite a bit, 2.5%. By the way, Microsoft was already 3% up in the morning today.
Really,
It's doing
they
quite
rebounded.
Well, and then you know what? The other thing is, here's the problem. See, it's like a swing. Inflation's probably going way through the roof for all the reasons I say. Energy prices through the roof. But then in 2026 and sooner, when the government is going to be printing money left and right to cover the Medicare deficits, which are gigantic even compared to the market, they're going to have to drop rates lower. So maybe rates go to zero, and that's not going to be good for the finance companies at all if they bring it down. And they almost have to, because they are not going to want to pay compounded rates, and neither are other countries, on more money that's owed than all of stocks, bonds, and privately held real estate in the United States. And that's how much they're going to owe, most likely. So the problem is, then, so how are they going to handle this? Because they need rates to go way high to control inflation, but they need rates to be zero in the next few years because we're having this huge money printing issue. So it's very complex. You know what? Before we get through, because we're down to roughly a half-hour format, I just want to give a real synopsis of what I did with energy. I'm not going to go into all the companies specifically, but I love these investments, and they've been doing fabulously, obviously. But MPLX, 20%. It's unbelievable. Paid a special dividend. It's by far my favorite. I'm actually over 20%. USAC, I've mentioned before, 5%. EPD, I'm now up to 0.5%. And I will mention that Goldman Sachs put out something, Goldman Sachs midstream bullish stance, and they talked about 3 companies that they're very bullish on. And MPLX was one of them, and EPD was another. And then AM, I'm 2/3%. Sunoco, which is gas stations, 1%. I bought some CVX at 0.25% roughly. And I even considered Gazprom, which for like 0.1%, but I stayed away from it because it's Russian and there's a 25% tax. But so I'm going for it on energy, and I just don't see any way energy is not going through the roof in the next 2 years.
Yeah, I agree with you, Peter. And as I said, I unloaded Enbridge at $37, and no, I sold it at 42, but I got back at 37, and now it's over 42. So it was a good timing for me, but I shouldn't have done that because I was considering doing the same thing with BTI, which is British American tobacco company, and I wanted to sell now because it's on a very top of its range. But then I was analyzing, why would people who own British American, why would they sell? In fact, I think it attracts even more buyers, especially in Europe. And don't forget it's UK company, so their brands are popular all over the world. So I decided against it. So I decided to hold on to that,
Yeah, I
and
think you probably do well with it. Yeah.
Peter, would you prefer energy over pharmaceuticals? Because I did pretty well in pharmaceuticals last couple
You know,
months.
pharma, actually, I sold my THQ this week because I
Yeah,
saw it was going down. But here's the thing. I mean, first of all, if you look at healthcare on this chart, which is the chart I showed last week, maybe we'll post this one week, but it showed that in 3% rate environments, 3% plus inflation environments, for about 50 years, from 1973 to 2020, healthcare was had an average return over inflation of about 1%. So you did beat inflation, but it wasn't
right.
dramatic. Right. But it was only beating inflation about 52% of the time.
Yeah,
So it's like, if I'm going to own something, I want to either get a big win or I might as well just stay in fixed. I want to get the energy where you have 73% on the same chart chance of being over inflation with an average return of about 9%, 8 or 9%. That's appealing because that you compound that over 10 years. That's a lot of money. You compound at 1% over inflation, that's not going to make or break you. And you could even be below inflation. So it's just not as appealing. Consumer staples was at least decent with a 3 or 4% return over inflation, but maybe 3%, but that was 55% of the time.
yeah.
But it would still beat healthcare because even utilities had a better average than healthcare, by the way. Utilities averaged the same, like 52% chance of beating inflation, but it was 3% higher. So if you look, it's not a bad sector, but if I'm going to take a chance on anything, I'm taking it on tech because
Right.
that's not even on the chart really, and I don't know where it'll wind up. But
Yeah.
big tech like Amazon and Microsoft, because I think they can fight inflation. But they're all packed together. A lot of these other industries, industrials, financials, they're all in the range of just keeping up with inflation in the realm of plus 2%, minus 3%, something like that. You're not getting the dramatic compounding.
Yeah.
So to me, it's energy and equity REITs did very well too.
Right.
But I'm staying away from anything that owns an
Yeah.
office. But I have
now,
to
if
have
you're
a full
looking at
apartment.
Peter, if we're looking now at the option trades, I'm looking at two stocks to sell puts. One is Microsoft and one is Nvidia. Nvidia went big time all the way down from 330 something to 260 as we speak. And Microsoft went down also big time, although it's up today. So I think that on Nvidia, I'm looking at uh, June 280 puts to sell. And on Microsoft, I would go even for 320 puts to sell. So
Oh
it's,
wow.
yeah, I would go. But don't forget that
Oh
next week.
wait, that's what I have. I think I have 330. What is Microsoft at now? It's the 315.
Microsoft is 310, give or
Yeah,
take.
yeah, I have long-term puts on 330s, which I did a long time ago, so they're in the
Mhm.
money for sure. But yeah, no, I'm not sure. See, that's the thing. I see tech is swimming against the tide now for the next few
Yes,
years.
yes, it is.
So
Yes, it
on
is.
one, you have two forces that are incredibly powerful: inflation and increasing rates are going to hurt tech. But these companies are they have such growth in revenue. Like Amazon is like I was going to talk about that, but I think we better save it for the next show because we're running over the 30 minutes. But so maybe we should talk about it. But I think tech, especially selling options on tech, is a great idea. But we better you know cover that next week.
Absolutely. Okay, so we've covered today high yield dividend stocks. We had a few investment ideas. We just touched that. So obviously, we will explore it further next week. And maybe I will be in a position, instead of discussing the potential idea, to actually discuss the trades that I will make during the next week or so. Especially, I'm very, very attracted to Microsoft and NVIDIA selling puts. I just have to be very careful what kind of puts, the strike price, and the expiration date. So I have to qualify that. Hopefully, we'll be doing that in the next few days. So thank you so much for participating in today's program, and we'll see you all next week. Thank you very much. It's Modern Investing with Sasha, IBM TV, Pod TV. Thank you very much to all. Bye bye.